Welcome to our webinar on the emerging S&B asset class. I'm Alycia, and I am the CEO of Seraf, and this is Taylor, who is my co-founder at Harriet Ventures. And there's like a long backstory there that I'll get into, but we bought Seraf about 2 years ago, as it was our first acquisition that we made in the S&B asset class. And this is also why we're very excited about the space. This is like a very near and dear kind of topic, and one that we love to talk about outside of what we do on the daily. So how this will work, I've got educational slides here. There's a fair number of them, and they go into a fair amount of detail. I'll go through the slides just to kind of get you guys like an overview of how things work and introduce you to the asset class and help you understand what the market looks like and what's driving it, because I think that's always very important if you're looking at it both from the outside and the inside to understand what's going on. And then we'll do Q&A at the end. So, but here, we'll go ahead and get started. So again, as I said, I'm Alycia, and I own Seraf with Taylor, and Seraf has like two components. We have the software company, financial software, to help people track and manage their investment portfolios. And then we also have the Seraf Compass, and that's where you probably heard about this webinar. And the Seraf Compass is where we do weekly written educational blogs around venture investing and private market investing, but then we also do live webinars pretty much every month at this point. And those are just on various topics that we find interesting. A lot of it is really just our own curiosity projects, and so things that we find interesting. Next month we're doing one on secondaries markets with Hive, which is a big secondaries marketplace based up in Canada. After that, I forget the one that's next, but generally on a monthly basis we try to do live education, because I think that that's helpful for people to be able to ask questions to people that are in the spaces that they're interested in. So that's us, and that's why we're here today. But with that, let's go ahead and talk about this, what I would call an emerging asset class at this point. It's still very, very small comparatively. So if you look at like the private markets as a whole, the way that we kind of define and segment those, right? If you have private equity, that encompasses private equity as most people say the term, where you have leveraged buyouts and you have turnaround situations and roll-ups. And then you also have venture capital in all its different forms. What we're talking about here is pretty close to classified as micro private equity. And so when we talk about this asset class, the things to understand, if you're just kind of starting to look at it, would be the market trends and why at least I think it's going to be something that's on the rise for the next 10 to 15 years, at least. The investment strategies, challenges and opportunities, because S&B investing, small business investing, is very different than venture investing. And so each of these asset classes have really unique struggles within them. And I can tell you from experience. So on the Seraf side, we work with a lot of angels, we work with a lot of venture capital firms, a lot of family offices that are investing in early stage venture. And that is drastically different than what we do at our like holding company level, Harriet Ventures, where we acquire profitable cash flowing companies. And then we're not trying to hit a hyperscale level. We're just trying to pace for, 15, 20% growth year over year, right? So like a very different model, and with very different returns and a very different set of struggles, I would say. And then we'll have a quick sneak peek at our launch, because we are launching something at the end of this, and there will be a pitch. So at the very end of that, you guys will get to see. So an overview of what the asset class is. So when we say S&B, that really means small and medium-sized businesses. Typically, that's going to be under $20 million worth of enterprise value. And a lot of these businesses are like I won't say mom and pop shops, because the majority of those you probably don't want to buy, but we're talking about the acquisition of construction companies, healthcare tech companies, manufacturing companies, accounting firms, legal firms, like very core and structural companies in the United States primarily. I would say this wave has a little bit hit Europe. So you start to see some acquisition, like small acquisition activity over in England, maybe some in France, but largely this is a United States phenomenon. And that's because this actually came out of this whole model of buying a small business and then operating it, mostly as an individual operator, came out of the search fund model from Stanford. And so the term search fund fits exactly into this asset class. And that is a scenario where you have an individual, most likely an MBA, and they decide that rather than going to work for Morgan Stanley or whatever, they want to then instead do that. They want to buy their own company. And so they set up a fund, investors contribute to that fund, and then they go on like a 1 to 2 year search for a business, typically in like the 3 to 4 million and up EBITDA range. So they're looking for companies that are a little bit larger, and then they take over those companies. They run them, either continue to just take cash flows or eventually sell that company, ideally bigger when it's bigger than what it started, right? Because then you have a little bit of multiples arbitrage that you have at the end of that. So that's what I'm talking about when we say SMBs as an asset class. Mainly these are acquisitions. I will drop in here that it could be interesting. I think we'll maybe start to see a little bit of like in the market, we're starting to see people who want to continue to operate their business. So they started the business 10 years ago. It's grown to some level of size, and now they want to sell out 20% or 30% of that business just to get some extra liquidity. And that's something that I would equate to close to secondaries, like when founders sell out stock, but on a very, very small scales, just so that individual operator can get some liquidity. So that's what we mean when we say S&B asset class. The players in this market, you have a very, I would say fairly simple, like two-sided model, right? So you have the investors who are funding deals. Those are like funds, syndicates. You have to be accredited in the space to invest in these types of deals. Family offices, independent sponsors. The term independent sponsor is probably not worth going into now, but I dropped them on the investor side as well because they're not actually, they operate, but they place operators. So it's a little bit different. And then on the other side, you have the operators, the acquirers. You'll also hear the term searchers. So people who are searching for a business call themselves searchers. And in order of what I think is most frequent, you see MBAs at the top. So people who have done an MBA program decide they don't want to go into corporate and they want to buy a business instead. Second to that, you have people who have operated kind of in the startup realm. And so like Taylor and I happen to fit that criteria, both of us, in that we started out in startups, COO spot, and then we got really good at operating companies and decided we wanted to start buying them and then operating them. So you see startup operators kind of joining the space as acquirers, and then you also see people who are in corporate now but want to get out of corporate. So they've started and they're like trying to get out of the rat race. They do XYZ at Google and now they want to go buy their own business because they've saved up some cash and they can now do that. And then right in the middle, you have the transaction service providers. And these are just transaction broker people, right? So you have your lenders, you've got your brokers, you've got your attorneys, accountants, anybody that kind of surrounds getting the transaction done. And that's pretty much what makes up the ecosystem right now. I would say we're still pretty early days in my opinion. I think search funds, the original version of them popped up maybe a decade ago. And then it really started to disseminate in multiple forms and fashions over the last like 5 to 8 years or so. So this is kind of what the ecosystem looks like as far as people who are moving in the space. Market opportunities here. So the reason that I think this is on the rise, and this kind of feeds into like the rest of this presentation, is there's a lot of baby boomers who are retiring and they don't have a succession plan. And this is specific to the United States, where and it's very hard to get numbers on this as well. Otherwise, I would have put them in here. So you'll see varying studies where some say like 3 million, some say 10 million, some say $1 million per year for the next 15 years. Like it's really hard to know because it's all private markets and they're all smaller companies. But I can say for sure, there are a lot of business owners who are aging out of the market and they either don't have a family member who wants to take over the business, or they don't have any other succession plan within the business. So they don't have like a really strong manager who wants to take it over, or they don't have like someone external. So ultimately those small businesses either shut down or they go to market. And so that's kind of what you're seeing here. That's called at least in the S&B space, what we would title the silver tsunami. I know that means different things to different people, depending on how you look at it, but really people are getting older, they have big businesses and they don't know what to do with them. The other thing that is important here is financing is very accessible via the SBA. The SBA now, I think I question it a little bit more in that our administration is doing some weird stuff with lending for small businesses. But right now, a searcher, if I was trying to buy a business for $3 million, right? And that's my example in here. I'll go through a deal breakdown with you. But if I wanted to buy a business for $3 million with the SBA program, you can finance 90%. Technically 95% if you do it really creatively, because Taylor and I have done that. Technically 95%, but 90% the SBA will cover. And these SBA loans are administered through local banks, right? So Live Oak Bank is a big one. Truist, I think, does SBA loans. Like a lot of the local banks are SBA partners. And so they administer the loans. And then the government is guaranteeing 75% of this loan. And that is also why it's very attractive to banks when they can pull off an SBA loan, because the vast majority of that capital that they deployed is guaranteed by the US government. And that is a very accessible way to buy a business. Whereas if you had to come up with the conventional commercial loans are kind of hard to get because you have to have collateral. And as somebody, if you're just coming out of an MBA program, you don't have a lot of net worth, the SBA is the route to go. The third thing here is the operational value potential. We focus on this really, really heavily with our holding company because that's something that we as operators can add value at. Particularly what we've seen is that people coming out of MBAs and people coming out of like high level corporate situations or people coming out of startups tend to be a lot more tech forward than the people who are retiring out of your average 30-year-old construction company. And so there's a lot of room to add technology, optimize processes, sort of just professionalize what the organization is doing in the markets with like really legacy businesses in them. So there's a lot of opportunity here. A few more details on why things are gaining traction. So there still is, I would call it an outsized return on average relative to the risk in this asset class. And I think that's also just the nature of it kind of just starting out. And when your capital is limited, that capital gets to demand the terms on which it is returned. And so we'll go through the deal and you guys will see exactly the waterfall if you take on capital to acquire a company. But there's a bit of advantage here for the early movers. Diversification benefit. So obviously SMBs are very different than the stock market, very different than real estate, very different than startups. So it just kind of diversifies the portfolio. There's a lot of capital that is starting to move around as far as private credit, both via the SBA, but also through private lenders. So private credit is kind of starting to have its day, in my opinion. Like that's something that on the Seraf side, we're actually focused on because I think it's just on the rise. In this graph here, you'll see that just if you ignore the spike up from 2020, because those were all the COVID loans, but you have a pretty steady growth rate here as far as the US business loans being deployed into small businesses. So that's that. The last one here that I think is important, impact investing is something that has transitioned in the SMB space to be like, when I say impact investing, most people think like ESG or climate investing or diversity and equity investing. What I mean here is that people find impact in investing in local businesses so that local business does not have to shut down, because that's the alternative. If an operator does not buy your 30-year-old manufacturing company, that company doesn't have any option except to shut down, right? If you don't have a succession plan, there's nothing to do with it because that owner is going to age out at some point and they need to figure out what they're going to do for the rest of their 20 years of life. And so it seems that people find a lot of impact in financing these acquisitions so that the business can stay local, the employees are retained with that local business, and then someone can come in and operate it and kind of shepherd that company into the next phase of ownership, the next phase of growth. And I'll pause here quick. Taylor, anything to add? Because I'm going through this at a pace that I hope will get us through to like 10:30, and then we'll do Q&A.
No, the only things I want to add is going to come up in your next slides. So
Okay,
rock and roll.
cool. So investment strategies. There are two different ones that we have seen that are going to be most frequent. Your very standard investment strategy is going to be your LBO model, where you have a business that's been operating for the last 15, 20 years. Debt is taken out against that business, either the assets or the free cash flow, probably both in most cases. And then you utilize that cash flow to pay down the debt as you go along and just continue to own the business. This is facilitated by the person who will be the operator in most cases. Again, so you have like me as an example, right? If I'm an MBA and then I graduate, I decided at that point I wanted to buy Seraf. And so I went down the path of figuring out, okay, what is Seraf cash flow? What debt should I take out? What's the price? How do I find investors for this thing? And like put it together. And the operator is the one that initiates and puts together the deal. The second strategy here, this one is, I have questions about it, about who can actually execute this, but is a roll-up strategy. So similar there, you buy, one acquisition is like your platform company, your main core company, and then you bolt on acquisitions to that company. Because what happens with the valuations, I skip valuations in this presentation, but I have it in the appendix if we want to dive into it. But what happens with valuations is like the higher the cash flow goes, if you hit certain milestones, typically like $1 million worth of cash flow, $2 million worth of cash flow, above 5, like that means that your multiple on the purchase price or the sale price of that company or group of companies is going to go up. So your average cash flow multiple that people are paying right now is like 3 to 5x cash flow for an acquisition. The higher your revenue and the higher your profit's going to go, the higher that multiple is going to go. So you have people now, more, I would say more established operators, people who like know what they're doing at this point, buy one company and then you're bolting on a bunch of other companies, kind of centralizing the back end and then trying to sell that for a multiple that is higher than what you bought it for, ideally. So that's the roll-up strategy. Certainly number one is going to be way more frequent because number two, the roll-up strategy takes quite a bit of skill and forethought as far as industries. And then you also see, this is part of the reason, not to go down too much of a rabbit hole, but this is part of the reason that private equity is getting a really bad name right now, in that they're buying up like HVAC companies and plumbing companies and making it seem as though they're all separate companies, right? So like they'll buy up, 5, 10 of these types of companies. They're very fragmented, small companies in an industry, in a market, and then centralize the back end and then hike prices. But then like it's all the same company. And so PE has figured this strategy out, and that's what most of them are trying to execute on. When I say PE, those are people who are looking for like acquisitions 10 million cash flow and up, whereas a lot of the S&B investors, S&B operators are like certainly lower than that. So those are the two strategies. I did have turnarounds on here because that's like a PE strategy thing. It's not what you would see in S&B investing. And so I took it off. But these are the two worth mentioning as far as investment strategies. So this is kind of where we dive into the details of how a transaction works. This has a lot of assumptions in it. And the next webinar that I'm going to do about this is going to be like a deal breakdown, because I think that's probably the most helpful thing from a learning standpoint. If people are interested, it's totally okay if you're not, but here's your cash flow waterfall. So the premise of the deal here is that you have a $3 million acquisition. So you get to this $3 million acquisition, you're basing that on a multiple of cash flow. $1 million worth of cash flow right now at a 3x valuation is a really good deal, in my opinion. Most of that is up to the 4 or the 5x, but for the sake of modeling, this is what I put, right? So you have $1 million with cash flow, you paid $5 million or $3 million for the deal. For this $3 million deal, you need 10% cash. So if the acquirer is using an SBA loan, you need 10% cash for that SBA loan. So you need $300,000. And this is the part where the investors come in. The SBA loans that are taken out against the company, they sit on the company's balance sheet. And the operator, the person that's acquiring the company, typically is going to personally guarantee that debt. So there's a risk there for the operator, but if they're confident, they're in most cases willing to do it. Payments then, after you've acquired the company, you've got a $2.7 million SBA note to acquire it at 9% interest, which is about average right now, over 10 years. All of the SBA loans that are taken out are over 10 years because that's just what the SBA has deemed standard. So then your payments annually are going to be $410,000. Your operator salary is going to be somewhere around 150,000 with benefits included. Maybe base is 100, and then you have like healthcare and you have other things on top of that. So about 150 is kind of market standard right now. So let's shift over to the right side. For the $300,000 that the investors would have put into this deal, they got 15% of the equity. This is also pretty close to standard. You might see a little bit more than this. So it's not a one-to-one basis. If you're putting in 10% of the capital, you're going to get somewhere around 15 to 18% of the equity in the company as an investor. And then the operator, the person that's buying it and guaranteeing the SBA debt, gets 85%, maybe a little bit lower than that. But this is ultimately what the structure ends up being as far as equity in the acquired company. And then finally here down the bottom, the cash flow waterfall. So this is how the cash flows actually work. You have this year one cash flow of 440,000. This is post debt, post searcher salary, what you end up with for free cash flow, right? So we started with $1 million, we had to make our debt payments, and then we had to pay our searcher, and then we ended up with 440,000. From this 440,000, the investor capital is always returned first. So searchers cannot do distributions. Well, you have to set up your legal agreements properly, but industry standard is such that searchers, they don't take any distributions besides their salary until investors are paid back. So investors are paid back their 300,000 over a year or 2 years or 3 years, whatever cadence. That's the thing that's uncertain, is the cadence on which the searcher decides to pay back, or the operator decides to pay back that money is in question. They're certainly motivated to pay it back sooner rather than later because of the second part here, because investors are paid back first, but they're also paid back a preferred return on top of that invested capital. The preferred return is like, it's almost like an interest rate. So it's based on the outstanding amount of investment that the investors have committed. And that's an annual metric, right? So if I paid this back in 1 year, I would have to pay back my 300,000. I would have to pay back 30,000 if my preferred return was 10%. And then any leftover after that point, so after investors have gotten all their capital back and their preferred return, based on how many years that capital was outstanding, then the rest of the distributions are split equally for like this top ownership number here between the operator and the investors. I'm gonna pause because this I see some Q&A stuff coming in, but you guys can continue to drop questions. We can always come back to this because this is fairly like complicated, I suppose, maybe better done on a spreadsheet. But then after that, so after investors are paid, 374,000 to the operator, 66,000 to the investors every year after, or whatever that portion of cash flows happens to be, to the investors until the company is sold, at which point the investors get 15% of those proceeds as well. And that's how your standard cash flow waterfall is going to work in a small business acquisition. Cool. Just to touch on the challenges here in the industry, and I do have, so if we have extra time at the end in my appendix, I have two valuation slides, so we can talk about S&B valuations. But here, with startups, if you're investing as an angel in startups, you have a lot of different types of risks than you do if you're investing in a small business, because a small business has been around for ideally a long time, over 10 years, and it's been established. Ideally, it's got some sort of slow paced growth, 5-10% per year. So it's a lot more steady of an investment, whereas startups are going to be quite unproven. You have risk related to fundraising rounds, you have risk related to dilution and whether or not that company can exit. The vast majority of startups are going to fail before they hit profitability, and even after they hit profitability, there's still a risk there. And so the startup risks are very different in that they're like meant to be high growth, high return, right? So you're trying to return your whole bucket of invested capital with one deal that does really, really well. Whereas S&B investments, the risk that they carry is very heavily reliant on the operator. So if you think about any small business, even if you had 15 employees at this small manufacturing company, maybe you have like a manager or two, but it's still heavily reliant on the owner that's transitioning out. And then you have to have an operator that can step into that owner's shoes and do it effectively. If they do not have the appropriate operator experience, I would say it gets quite a bit more risky, because I don't know that I would back somebody taking over a business if they've not managed people before. Like, and you do start to see that, right? Because it's very accessible now to understand how you go about buying a business, at least in theory. I would find it hard to back someone without that type of experience walking into an S&B deal. You have higher borrowing costs, right? So the S&B debt or the SBA debt is going to be 9%, and most of that is variable rate, right? So that's pegged to prime, and that's going to kind of fluctuate as the Fed sees fit. It's harder to exit S&B acquisitions. It's hard to exit startups too. I think it's getting easier with secondaries, but small businesses, you really don't have, we've not evolved to the point where there's like a secondaries market for small business acquisitions, right? If you hold stock in a small business, you're probably stuck with that until the company sells. Maybe you can find something, but more than likely you should plan to deploy the capital, and then like you're letting it sit and then cash flow for a long time. And then the final thing here, number 4, is that unless you're executing on a roll up, the pace of growth for small businesses is also a lot slower, right? So you're hitting like 10%, 15% per year is pretty good as far as a small business goes, because a lot of these you're scaling off of profits. You're not scaling off of venture capital dollars. And so you're limited in what you can force as far as the growth goes. So those are the kind of risks and how I would look at startup investments versus small business investments. And I wanted to include this slide because I know that a lot of people on the call are angel investors and people who are investing in venture. And it's kind of at least helpful for me to think about the differences between those two types of investments. Next slide here. So that concludes my educational part of this outside of the Q&A. But me and Taylor are launching our syndicate. As an overview for you guys here, so our syndicate, which is new off the ground as of today, we've been planning this all summer and sort of putting together the back end for it, and we're very excited about how we see this working. So it's called S&B Angels. We wanted to call it S&B Angels because we would be set up like as a syndicate, as an angel group, except we're not investing in startups. It's to invest into S&B acquisitions, so to help other operators buy companies. Taylor and I have acquired 2 companies with our holding company. We will continue to acquire because that's what we find that we're good at. But we want to now help other people do this. And what we found in the last deal that we closed was that capital in this space is still very fragmented. So like the previous slide that I had up, you have a lot of different like individual high net worth people, a lot of family offices, but not very much institutionalized capital. You do have a number, probably 6 or 7 funds that I could think of, like fully committed funds, but that's about it. And then otherwise you're raising capital on a person by person basis, which is inefficient, and we're operators and we don't like inefficiency. So we're trying to combine capital, community, and education to grow profitable and recession resistant companies. So very boring type companies. Again, we're looking at construction and healthcare and B2B services, and we're not touching like restaurants or things like that. And we're also not touching high growth, high tech startups. That's not what this syndicate is for. If you would like to be involved, so we're going to be your standard syndicate 2-sided model, right? So you have operators who are looking for capital, you have investors who want to commit that capital on a large or small basis, and then we're syndicating the deal to put that together, doing the diligence and kind of executing that. And so if you would like to be involved, feel free to contact us. Our website's up, our email's up, LinkedIn is up, but I haven't posted anything yet. So if you want to go ahead and give a follow on LinkedIn, please feel free to do that. But that is what we've got going on over here, because I think it's important that we start to institutionalize and standardize the way that capital is flowing into the space because the way that I see it, if we don't do that, right, if we don't start to have sort of standardized capital sources, then the fewer deals are going to get done. And the deals that don't get done means that the company shuts down. And I don't think that most people would want to see that happen. Like I live in St. Petersburg, Florida, and we've got a lot of great little businesses here. And I don't like the idea that they would just shut down for the fact that nobody wanted to take them over, when I know that there's probably an operator that would take it over if they had the funding and the knowledge to do so. We're kind of combining the education with the capital structure to then ideally do more deals in the SMB space. And that is where I will stop us as far as the presentation. And Taylor, chime in if I missed anything important.
I mean, I think besides just the impact that this type of activity has in communities, especially for those of y'all that are in America, for American small businesses, I do think it's an asset class that genuinely deserves to be taken seriously. Like Alycia said, Alicia's been a board member on various different startups. We've been C-suite executives at high growth VC-backed tech startups, and we've seen the struggle to get to profitability, and we've been really impressed and super surprised by the two deals that we've done, but also, deals that we've seen others in this space doing, and what type of returns they are getting. And so we also just think it's a really great asset class to be in. Because we've been in the startup world and we've also been on this side of the house as well. We've gotten to kind of see the difference in risk and risk mitigation strategies between the S&B kind of asset class and VC kind of investing. So we really think it's worth considering, and that's something that we care passionately about. It's a big reason why we want to start the syndicate as well, just to educate more folks, give people more opportunities to see for themselves what this asset class can do, and what makes it unique in its value proposition. And yeah, I just wanted to add that, Alycia, because I think there's like kind of the impact side of it, but there's also too just like from a financial perspective, it can be a very strategic and smart place to park some capital.
Yeah, I would agree. And we can go to Q&A too, because I've got two of those. So Felicia says, where are you finding these SMB businesses that could be potentially for sale from a baby boomer, for example? Good question. So there's two ways to look at that. You can look at things that are listed on the market. So sellers that know that they need to transition, they need to retire, and they've decided to contract with a business broker, to sell their business. Those listed businesses, there's like, I don't know, 5 or 6 different platforms that you could find them. If you just like search SMB sale platform or something, you can find the ones that are listed. The off-market deals, so primarily what we do with our holding company, we look for things that are off-market, because the things that are off-market are way better deals than the things that are on-market. Like if you think about, if you contract with a broker, that broker probably knows the market, and then that broker probably wants to overprice a little bit for negotiation purposes. And so you might get an okay deal, but you're not going to get a really good deal, which is what I think operators should be looking for. And so typically with all of our off-market sourcing, it's anywhere from like cold calls, cold emails, cold letters. I've literally hand dropped off letters to businesses in St. Pete. Like you have to get creative with how you reach these people. Conferences are probably a big thing. I find that quality over quantity when you're doing outreach, as with anything. But yeah, it's really just trying to get in touch with owners and see who might be ready. Otherwise, you can look at listed deals. Second question's an easy one. So is the presentation available to participants? Yes, I will send this out. So you guys will all get the recording in about a week, and you'll get the presentation with it, just because it's already made it. So I might as well share it. Third question, are there restrictions on the amount or frequency of SBA loans taken by an operator owner for an acquisition? Yes. Typically, if you take the SBA loan limit for any given industry, and this will vary per lender because really it just depends on the lender. Most of them say if you can get 2 industries, $5 million worth of capital each, $5 million worth of SBA loans. I've seen lenders, so Regions Bank is a big one. Region is very flexible on those requirements because the SBA, the way that they wrote the procedures, the SOPs are unclear. So they mean for the cap to be 5 million. But they say 5 million per NAICS code, which means by industry. So if you have a different business in a different code, like for us, we are very diversified. And so like in theory, most say, 2 industries, $5 million each worth of loan volume. They also want you to wait 12 months before getting another SBA loan. And I say it's not a specific requirement. It's just that the lenders look at you, they squint at it real hard. If you have bought one business and said that you're going to be the operator, took over as CEO, and now you, like 3 or 4 months later, you want to buy another one that's not a bolt on to the first one. If it's a bolt on to the first one, very related, you can do that a little bit faster. If it's entirely different, you probably gotta wait 12 months. Amy, good question. How long did it take us to find our two deals? 2 years total. Well, so it took 6 months for the first one for Seraf. It took, so I don't know, a year and some change for the second one. I do want to increase our pacing there at the holding company to do one every like 6 months or so. It's just the amount of time, the way I see it, the amount of time to buy a company, take it over, get settled into management and feel good about it, and then implement the changes that you want to see at that company to make it more operationally efficient and try to scale growth a little bit. It's probably at least like, it's probably a 6 month endeavor at a minimum, depending on the company and how niche it is. Yeah, it took us a little bit. I know that there are independent sponsor companies that are doing like one deal a quarter, one deal a month, that they have a fully blown back end team. So like they've already centralized accounting and legal and everything on the back end. And so like now they're just like an acquisition engine. There are people who are doing that. And then a lot of like very small operators who are just looking for one company to buy. And with the syndicate, as far as SMB Angels goes, that's who we're trying to back, is like the single operator who does not want to go into corporate. They want to buy their own business, run that business for a while, scale it, and ideally just continue to benefit off of the cash flows for both them and their investors. Ryan, thank you for the question. So you mentioned that an operator would personally guarantee an investment. How would an operator approach this? Are they contributing their own capital to the business? Yes and no. So you might see deals where the operator, the person acquiring, puts cash into that equity injection. You might see deals where they don't. It really just kind of depends on what the investors see. As with any like fundraising round, I would say they're always more attractive. The deal is more attractive if the operator is putting in their own cash, because similar to if a startup founder is investing, even if it's $10,000 into their own fundraising round, it shows a level of commitment that you really can't express otherwise. That personal guarantee is a big thing. And that if you buy a company, you got a $3 million loan on your head, and if that company tanks, you still have to pay it somehow. You have to find a way. It's probably going to bankrupt you, and you have to be very confident in your ability to run and keep that company alive at the very least. So that the PG is something that I think makes operators, like would-be acquirers, shy away from the industry, because that's a not very attractive loan structure. But then again, you own 85% of the company, and you have, if your company is doing $1 million worth of cash flow and you can't figure it out, then that's probably a personal problem. Is kind of what I would say. So yeah, good question.
It's not for the weak though, the personal guarantee piece. And not just
No.
not for the weak, but also there's folks who, maybe because of their family or where they are in life, age-wise or something, it's a little bit harder to stomach a personal guarantee than folks maybe getting right out of an MBA program, still kind of open to it more, taking more risk.
Yeah. Yeah. And it's also, for clarity, the investors are not personally guaranteeing anything. That it's just the searcher that is on. So cool. All right. I've not got any other questions in my Q&A. So thank you all for joining us. Again, this recording will go out next week at some point, probably late next week. And if you guys want to have a conversation or join the syndicate or talk about joining the syndicate, or to stay up to date, please join the newsletter. So we'll do a monthly newsletter that'll go out to anyone who's registered, and you'll see all the events, all the webinars that we're doing relative to the syndicate. Also, please stay involved with the Seraf Compass, because that's where kind of all of this came from. Is we bought Seraf and decided now we want to help other people buy companies. Thank you for your time, and have a good rest of your week and weekend.